In 2025, silver did something no one expected, and very few understood in real time. A metal that spent decades moving slowly, quietly, and often frustrating investors suddenly exploded. In less than 6 months, silver prices surged from the mid-30s to over $80 an ounce, shocking global markets and forcing analysts to rewrite long-standing assumptions. Some called it a speculative mania. Others claimed it was the beginning of a structural reset. But when the dust settled, one thing was clear. Silver was no longer behaving like the forgotten cousin of gold. This video breaks down what really happened, using real data, official reports, and market records, and explains why silver's 2025 move may still matter deeply in 2026 and beyond. At the beginning of July 2025, silver appeared almost irrelevant to most investors. According to widely used market price feeds and commodity exchanges, silver was trading quietly between $36 and $37 an ounce. For nearly the entire summer, prices remained below $40. Volatility was low, trading volumes were average, and analyst coverage was minimal. Financial media attention was firmly focused on equities, artificial intelligence stocks, and cryptocurrency markets. Silver, once again, was treated as a background asset. However, macroeconomic conditions were already shifting beneath the surface. Global debt levels were approaching record highs, inflation expectations were proving stubborn, and central banks were facing growing political and economic pressure to ease monetary conditions. At the same time, the physical silver market had been tightening for years. According to annual reports published by the Silver Institute, the global silver market had experienced persistent supply deficits since 2021. Yet for a long time, these deficits failed to trigger a sustained price response. By late summer, subtle changes began appearing in market behavior. Institutional investors started building positions quietly, well before silver made headlines. Technical analysts observed improving momentum and higher lows forming on long-term charts. As September approached, silver began testing resistance levels that had capped prices for decades. The turning point arrived in mid-October. On October 17, silver surged to approximately $54.48 an ounce, a level confirmed by multiple financial outlets and commodity market summaries. This move was historically significant. It marked the first decisive break above silver's 1980 nominal high. More importantly, it shattered a psychological ceiling that had restrained investor interest for over 40 years. Once that level was breached, market perception changed almost overnight. Following the breakout, buying pressure intensified rapidly. In early November, silver crossed $47 and continued climbing with barely any meaningful pullbacks. Momentum traders entered aggressively. Algorithmic strategies detected trend acceleration and added fuel to the rally. Hedge funds increased exposure, and options activity surged. By early December, silver's price movement had turned almost vertical. On December 9, silver closed above $60 an ounce, according to closing price data reported by Bloomberg and other financial news organizations. Less than 10 days later, on December 17, prices were approaching $66. At this stage, sentiment shifted from optimism to outright excitement. Media headlines turned dramatic. Retail investors, many of whom had ignored silver for years, began entering the market at elevated prices, driven largely by fear of missing out. The most extreme phase of the rally unfolded during the final week of December. Between December 26 and December 28, silver spiked above $80 an ounce. Several data providers reported intraday highs near $84. This surge occurred during the holiday period, when market liquidity is traditionally thin. As a result, relatively small buy orders were able to push prices sharply higher. Exchange-traded funds tracking physical silver experienced massive inflows, while futures markets showed historically elevated speculative positioning. Commitment of traders reports released by the CFTC at the time indicated that non-commercial traders held near-record net long positions in COMEX silver futures. This meant the rally was heavily leveraged, powerful on the way up, but vulnerable to sudden reversals. That vulnerability became reality on December 29. The CME Group announced an increase in margin requirements for silver futures contracts. This decision, widely reported by Reuters and major U.S. news networks, forced leveraged traders to either post additional capital or liquidate positions. many were unable or unwilling to meet the new requirements. The result was a rapid cascade of selling. Stop-loss orders were triggered, margin calls accelerated, and prices collapsed. Silver fell between 8 and 10% in a single session, the largest one-day percentage decline since the early 1980s. Because this occurred during a low-liquidity holiday period, the move was especially violent. Buyers temporarily stepped aside, allowing the decline to feed on itself. By December 30 and 31, prices stabilized in the low $70 range. While the correction was dramatic, year-end data confirmed that silver still finished 2025 nearly 97% higher than its early July levels, one of the strongest annual performances in modern commodity history. Monetary policy played a central role in this extraordinary move. During the second half of 2025, the U.S. Federal Reserve executed a sharp policy pivot. According to official Federal Reserve statements and coverage by major financial outlets, the Fed delivered interest rate cuts in 3 consecutive meetings. As a result, real yields declined significantly. At the same time, currency market data showed that the U.S. dollar index fell by approximately 9.5% over the year. This environment historically favors precious metals. Gold responded strongly, rising roughly 65% in 2025. However, silver outperformed gold by a wide margin. Analysts cited silver's dual role as both a monetary and industrial metal as the key reason for this divergence. The industrial side of silver demand has become increasingly important. According to the Silver Institute's supply and demand reports, 2025 marked the 5th consecutive year of a global silver deficit, estimated at approximately 95 million ounces. Global mine production remained relatively flat, while recycling volumes increased only marginally. Supply simply could not keep pace with demand. Industrial consumption continued to expand, particularly in energy and technology sectors. Data published by the Silver Institute shows that solar energy accounted for about 11% of industrial silver demand in 2014. By 2024, that figure had risen to nearly 29%. Electric vehicles, power grids, electronics, and medical technologies all require silver for conductivity and efficiency. While manufacturers have reduced silver usage per unit through efficiency improvements, overall demand growth has continued to exceed supply. China added another layer of pressure to the market. Trade statistics reported throughout Asia showed that between January and November 2025, China exported more than 4,600 tons of silver, while importing only about 220 tons. This resulted in a substantial net outflow of physical silver. Toward the end of the year, reports emerged, later confirmed by international news agencies, that China would designate silver as a strategic resource starting in January 2026. Export restrictions were expected to limit supply availability further, prompting traders to price in future scarcity well in advance. Financial speculation amplified both sides of the move. ETF inflow data showed billions of dollars moving into silver-backed funds during 2025. At the same time, futures market leverage increased significantly. When conditions shifted, that leverage worked in reverse, intensifying the sell-off. As 2026 begins, silver's outlook remains both promising and dangerous. Continued monetary easing, persistent supply deficits, and strong industrial demand could support higher prices. Some analysts have openly discussed the possibility of silver testing the $100 level under favorable conditions. However, risks remain substantial. A stronger dollar, higher interest rates, or a slowdown in industrial demand could trigger sharp corrections back toward the $50 to $60 range. Silver's 2025 rally was more than a price spike, it was a warning and a signal. The metal has evolved into a strategic asset shaped by monetary policy, industrial transformation, and geopolitical decisions. Volatility is no longer an exception, it is the new normal. For investors, the lesson is clear. Silver rewards patience, punishes leverage, and demands respect. Whether the next chapter brings new highs or painful corrections, one thing is certain: silver is no longer being ignored. And the story that began in 2025 is far from over.